Planning and risk. For a single company risk we have covered, and in previous lecture we started about risk of a group audit if we are going to conduct audit of a group company. So let's discuss one more auditing standards. ISA 600 relies on the work of component auditor. So in group audit, there are two types of auditors involved. One is principal auditor. Principal auditor means auditor of a parent company who will be reporting on two set of financial statements, one individual of parent company and other consolidated financial statements. And component auditor means subsidiary auditor. And subsidiary auditor could be our firm, could be any different firm. Either subsidiary auditor is our firm or different firm. Per ISA 600, we need to perform some procedures because the results from the subsidiary are going to be consolidated into consolidated financial statements. Who have verified those results? Component auditor. But if in future our report on consolidated financial statements proved wrong due to some problems relating to subsidiary results, who will be liable for that? We, principal auditor. We will not be able to say that this work have been verified by component auditors. We are not eligible for this. No, we'll not be able to say that. So that's why per ISA 600, while relying on the work of component auditor, we need to consider some points. We need to perform some procedures. So before placing reliance, on the work of component auditor, what we need to do, we need to check his qualification. We need to check membership of professional body. Before placing reliance on the work of component auditor, we need to check his experience, whether he is having experience of auditing proper or not. We need to check his reputation in the industry, whether in the past, if he has performed this kind of work, whether his report was authenticated or not. We need to make sure whether he is meeting any ethical requirement, mean following any codes of ethics or not. If he is following any codes of ethics, so what codes of ethics is following, we should make sure. We need to make sure application of standard in his work. Application of standards in his work, whether he perform work as per auditing standards or not, and what auditing standard he follow, either ISAs, International Standard on Auditing, or any other standards. And we should make sure involvement in his work, whether he will allow the review of his working paper to us or not. If for audit point of view, we need any extra work from him, whether he will be willing to do that or not. Because if he is not allowing us to review his working paper, ultimately we will not be able to check the quality of his work. If we are unable to check quality of his work, we cannot rely on his work. So before placing reliance on the work of a component auditor, we should check his qualification. How we can check his qualification? His membership. For qualification, we can inspect his certificates, qualification certificates, and for membership, we can confirm from professional body. How we can check experience of that component auditor? How we can check experience of component auditor? Experience through company profile we can check. From how long they are operating, how many clients they have audited in the past, what kind of companies are their clients. So through company profile. Reputation, how we can check that reputation? Industry knowledge, by taking knowledge from the industry. How we can check whether he is complying with ethical requirements and what codes of ethics he is following? previous history, or we can discuss with him what codes of ethics he is following. Application of standard in his work, how we can check application of standard in his work. Review of past working papers, and how we can make sure whether he will allow us involvement in his work or not by discussion with him. So if these things are positive, we should keep relying on the work of internal component auditor. If we are going to rely on the work of component auditor, we need to perform some procedures. Some procedure we need to perform at a planning stage. And some procedure we need to perform during audit. At planning stage, what procedure we should perform regarding component auditor's work? We should involve ourselves in planning of the component. Involvement in component means subsidiary audit planning, so that we can make sure what risky areas he is highlighting, how he is highlighting risky areas, whether as per standard he is performing or not. We should discuss materiality levels relating to the component that he has defined, preliminary materiality levels, so that we can make sure he has defined materiality based on 5% of profit, 1% of revenue, 1% of total assets or not. At planning stage, we need to discuss with him group of policies. To identify if subsidiaries are having different policies, different accounting standards. This means we need to require detailed disclosure in the consolidated financial statements. At planning stage, what we need to do, we need to discuss or agree work and a timetable. I mean, when he will complete his work, because first he need to verify subsidiary financial statements. After subsidiary audited financial statements, those results will be incorporated into consolidated financial statements. And after preparation of consolidated financial statements, we'll be able to conduct audit on the consolidated financial statements. So there shouldn't be any delay in our audit reports. That's why at planning stage, we need to agree if any extra work we need to ask him to perform for our audit purpose. And we will discuss the timetable with him, when he will start work, when he will complete his work, when the consolidated financial statement should be prepared, so that we can plan our work accordingly. As well as at planning stage, we need to discuss with him review of working paper. Whether he will share his working paper with us, whether we'll be able to review his working paper, when we'll be able to review his working paper. So we need to discuss with him whether he will allow us or not. Because if he will not allow us, this means we'll not be able to verify his work. These are the procedure at planning stage we need to perform. If component auditor is a different firm, if our firm is also component auditor, we don't need to perform these procedures. We know about everything. We know how our staff member, how our firm staff is performing audit over there. But if he is a different auditor, we need to perform these procedures at planning stage. During audit, we need to perform some procedures. What procedure we need to perform? We need to review the working paper of component auditor. To assess quality of work. We need to identify Any written representation obtained? Why auditor obtained written representation from management? Where there is a lack of evidence, to increase the sufficiency of evidence, we require extra evidence from company management. So we need to make sure regarding what matters he has obtained written representation from the company management. So that from consolidation point of view, we can see whether we require representation from consolidation point of view or not. We need to identify any management letter. What is management letter? Letter of weaknesses. If during audit, auditor is facing any issues, he has found any weaknesses in internal control system regarding any matters, regarding any area, he communicate to company management through letter of weaknesses. That is called management letter. So we need to identify what management letter he has sent to company management, so that from consolidation point of view, we can assess the significance of those weaknesses, whether those weaknesses are significant from consolidation point of view or not. We need to identify any related party transactions detected during the audit. So that from consolidation point of view, we can see whether the disclosure in consolidated financial statements is required or not. And if he has qualified the audit opinion for component, means subsidiary financial statements, so we need to discuss the reason behind qualifying component audit opinion, so that from consolidation point of view, we can see whether that misstatement is material from consolidated financial statement point of view or not. If it is material from consolidated financial statement view, this means we need to provide qualified audit opinion for the consolidated financial statements as well. So these are the procedures that we need to remember. Before placing reliance, what we need to consider? At planning stage, what procedure we should perform, and at during audit, or you can say at a final review stage, what procedure we should perform during audit or final review stage. So we were covering a question called Grissom, having three subsidiaries: Willow Company, Hodge Company, Brass Company, and we completed part A of the question, where we identify and explain principal audit is for 18 marks. And we have completed part C of the question as well, where we have stated some procedures to verify non-controlling investment and procedures to verify condition attached to the government grant. Part B of the question. And we were aware from this further information, your firm audit all components of the group with the exception of Brass Company, which is audited by a small local firm, Siddle and Company, based in Chocolate in other country. Audit regulations in Chocolate are not based on ISAs. And you have just received the following email from Warwick Stoke. Part B of the question: explain the factors. Explain the that should be considered and procedures that should be performed in deciding the extent of reliance to be placed on the work of Siddle and Company. While placing reliance on the work of Siddle and Company component auditor, what factor you will consider and what procedures you will perform. For how many marks? 8 good marks. What should be the answer? Factors and procedures you will perform while placing reliance on the work of component auditor. Factors mean this before placing reliance. What procedure we should write down?
interpret them with the scenario.
To verify these factors, what procedure we need to perform? Mean before placing reliance. We haven't stated when you have a placed reliance on the work of component auditor, what procedure you will perform at planning stage, mean after placing reliance. No. While deciding the extent of reliance, whether we should rely on his work or not. So these are the factors. How to verify these factors, the procedure we need to write down. For qualification, we will inspect the degree certificates. We can confirm from the professional body regarding membership. For experience, we can review company profile. For reputation, we can take information from industry consultation. Ethical requirement, we can discuss with the auditor what codes of ethics they are following. Application of standards in work, we can discuss with them what standards other than ISAs they follow, and we can review their past working papers. And for involvement in his work, we can discuss with the auditor whether he will allow the review of his working paper and he will be performing additional work if required from consolidation point of view. Mean how we can verify these factors. Not planning procedures, not during audit stage procedures. Are you with me? So let's move towards one more very good question on consolidation. Magpie. To me, this is the most difficult question ever appeared in AAA paper, where students struggled while sitting in the exam center because the requirements were a little bit confusing, more harder than the blue belt. It was easy question, not that good.
I tried writing it as if I'm writing the article, but it's
Yeah, there were different articles. Information was not summed up, but this was the difficult question, involving some accounting standard knowledge as well. Even the requirements were tricky to understand what he's asking for. So if we look at the question, the requirements are in between the question. This means we should read from the start and move towards the requirement because there is some story behind the requirement that we need to understand. So you are a manager in Magpie and Company responsible for the audit of CS Group. This means this is a group audit question. The following exhibit provide information relevant to the question. An email which you have received from Joda, and who normally send you an email being audit manager, your senior engagement partner. He's always behind you. This rascal is always behind you. Joda, the audit engagement partner. So you have received an email from engagement partner. You are the audit manager. Extract from the permanent file on the audit of the CS Group. Permanent audit file. What is permanent audit file? As per ISA 230, audit documentation. Auditor need to document everything he is performing on a client. Mean he need to prepare his working papers. Working papers are files having detail about the work you have performed, having detail about the knowledge you have obtained for this client. These could be paper file, could be electronic file, when you have prepared in words. In working paper, there are two types of files. One is PAF, stands for permanent audit file. And other is CAF, current audit file. Permanent audit file and current audit file. If we are performing audit of one client, this means we need to prepare working paper for each year audit. There are some documents that are of permanent nature that do not vary year to year. Those documents we kept where in PAF. And the documents relating to current year audit, Obviously, every year financial statements are different. You are performing different procedures, and the detail what procedure you have performed to verify different account balances that are relating to current year. So those documents that are relating to current year audit that we kept where in current audit file. What we kept in permanent audit file if we have obtained client business knowledge. When? At very first year at planning stage, because we obtained the spread of the client business knowledge, who was the main owner of the business, who are the main management of the business, who are their stakeholder, in what products they are operating. So that knowledge will remain same year to year. So that knowledge of business where we kept in permanent audit file, and the copy of knowledge of business documents we just copy paste in every year working papers. Organizational chart regarding structure of the organization. What is the structure of the organization? How many departments are there in the organization? Whether business is operating in one division, more than one division, that chart will remain same year to year. It will not change. So we kept where in permanent audit file. What else?
Sure.
Organization policies document that will remain same. Trade license, yes. What else? Constitutional document mean memorandum of association, article of association. What else?
Yes,
Long-term lease contract. Lease or long-term loan contract for 10 years, for 15 years, that will remain same. That will not change year to year. But liability is there in balance sheet. So these leased contract, loan contract, we will kept where in permanent audit file. This will remain same every year audit. What we kept in current year audit file? Planning memorandum relating to current year. Planning memorandum mean audit plan. What risky area relating to current year you have identified, to whom you have assigned what kind of a work, mean audit approach that is relating to current year, that will be changing year to year. So we'll kept where under current audit file. What else? Return presentation obtained during the year. Financial statements copy. Management letter that you have sent to company management regarding control weaknesses. And detail about current year procedures. Audit procedure that you have performed, what procedure you have performed on what area, what was the results, whether you have analyzed there is misstatement or no misstatement, the detail of the work performed, you will kept where under control file. So moving back towards question. So you are a manager in Magpie and you have received an email from audit engagement partner. That email is where in exhibit 1. Exhibit 1 is relating to email from engagement partner. Exhibit 2, extract from the permanent file on the audit of the CS group, means some extract from the PAF working paper, permanent nature, could be company information. And exhibit 3, notes from a meeting between Joe Doff, engagement partner, and Steve Eagle, the finance director of the group. Mean notes of meeting, mean what they discussed with each other. So that meeting in notes we kept where in exhibit 3. This information should be used to answer the question requirement within your chosen response options. Okay. To audit manager from partner regarding CS group audit planning. Hello, I have just been to a meeting with Steve Eagle, the finance director of the CS group. We were discussing recent events which we have a bearing on our forthcoming audit. And my notes from the meeting are attached to this email. One of the issues discussed is the change in group structure due to the acquisition of Canary Company earlier this year. The company have acquired another subsidiary during the year, that is Canary Company. Our firm has been appointed as auditor of Canary Company as well. which has a year ending 30th June 20x2. That new subsidiary. And the terms of the engagement have been agreed with the client. We need to start planning the audits of the three components of the group and of the consolidated financial statements. There are three components of it. Using the information provided, I require you to prepare briefing notes for my use, in which you part A for 7 marks, part B for 22 marks, and part C for 5 marks. Altogether, 34 marks. Part A. Evaluate the implication of the acquisition of Canary Company for the audit planning of the individual and consolidated financial statements of the CS Group. But you can understand from this requirement that you need to write down. Evaluate the implication of the acquisition of Canary Company for the audit planning of the individual and consolidated statement of CS Group. What he's asking for. Evaluate the implication. What is meant by implication? Issues. You need to evaluate the issues of the acquisition of Canary Company as the adding of one more company to the group, Canary Company, for the audit planning from audit planning point of view. What will be the planning issues relating to the addition of new subsidiary of the individual from individual that subsidiary point of view, as well as from consolidated financial statement point of view. We need to discuss planning issues for the individual company that we are going to audit first time, Canary Company, as well as we need to discuss planning issues relating to group audit. Student realized might be we need to discuss the risk, but when they move towards requirement B, that is requiring for risk of material statement. So in part A, we don't need to discuss the risk. We need to discuss planning issues. What are the planning issues? We discuss some points in audit strategy and audit plan. Those points are called planning issues. Relating to individual, what issues we need to discuss? We need to obtain understanding of the entity and its environment. We need to get a knowledge about the Canary Company, what operation they perform, how they are operating. So we need a knowledge about the industry. We need knowledge about the control system. We need a knowledge about the system in Canary Company. This is what planning issue relating to individual company. What are the planning issues relating to individual company? We need to perform analytical procedures to highlight risky areas at the planning stage while comparing current year results of Canary Company with previous year, so that we can investigate unexpected fluctuations. At planning stage, what we need to do relating to individual company, we should obtain a knowledge about the framework. Framework means law and regulation and accounting standard required for the company to see whether they are accounting according to IAS, IFRS or not. These are what planning issues relating to individual. But we don't need to differentiate individual and consolidated separate. We need to write down combine. What are the issues relating to group company? In previous lecture, we discussed three planning issues. If we are conducting audit of single company, now we are moving towards group. Or if we are already conducting audit of group, now there is a change in structure of group. So first we need to check adequacy of resources. Whether we'll be having enough resources to conduct audit of a Canary Company as well as the consolidated financial statements, because now the results of Canary Company will be incorporated into the consolidation. We need to revise materiality level, because now the group is going to be expanded. We need to revise our letter of engagement, because now management responsibility, auditor scope of work is going to increase. Ultimately, auditor fee is going to increase. That we need to agree again. And if we see the Canary companies are having year end of 30th June 20x2. What's the year end of the group? That is 31st July 20x2. This means there is another issue, planning issue relating to consolidation. That is what? Different year end of the subsidiary Canary company and rest of the group. So you should make sure whether they are preparing consolidated financial statements as per IFRS 10, like subsidiary results must finish before parent, and there must be a gap of less than 3 months. Issues. We're not discussing the risk. We are not discussing the chance of misstatement. We are just discussing what could be the issues relating to audit. Planning issues. So these 7 points we can discuss. Is that? This was the difficult requirement while sitting in the exam center. Students were totally clueless what we should discuss here. If we are not discussing a risk here, then what to discuss here? Because part B is relating to risk. Some started discussing about risk, and then they moved towards part B. They were clueless. Part B of the question. Evaluate and prioritize the significant risk of material misstatement to be considered in the audit planning of the individual and consolidated financial statements of the CS group. Again, this line confused the student. Individual and consolidation. Student thought that might be individual audit we need to perform separate, consolidated mean group audit we need to perform separate. No, this is not like that. In previous question, Grisam, we discussed about risk in one sequence. Relating to individual, we just put the heading of the issue. We discussed the accounting standard, what's the risk involved, we have discussed. And relating to consolidation, if there is an issue, we just put the heading, discuss the issue and chance of misstatement. We don't need to differentiate. We don't need to provide a separate risk for individual and separate risk for consolidation. Combine, we need to discuss. For how many marks? But the requirement is not finished yet. We need to discuss risk of material misstatement. Identifying any matters that are not relevant to audit planning. And while discussing a risk, you need to identify any matter that is not relevant to audit planning. Is it relevant to the auditor at stage of audit planning? Material matters. Immaterial matters are not relevant to the auditor at audit planning. What does it mean by this requirement? Now, we need to calculate materiality of each account balance against which we are discussing any risk. Like government grant, if there is amount given, we need to discuss its materiality first. If the amount of government grant is immaterial, we will say this is not relevant to audit planning. How many marks? 22 good marks. Till previous question, we can discuss one risk for 2 marks. 1 mark for discussing standard and 1 for chance of misstatement, meaning impact of the financial statements. From this question onward, 1 risk could be discussed for 5, 6, 8 marks as well. It will depend upon the question. How much information for one issue is given in the question. we need to discuss that much points, and one issue can be discussed for 4 or 5 marks as well. How? That's good. So part C, we don't know what is part C. Even below part C, there is some information we will see later on. So we are moving towards discussing risk of material statement and any matters that is not relevant to the audit planning. This means we need to discuss materiality of each issue as well. So exhibit 2 permanent file extracts. An extract from the permanent audit file describing the CS Group history and operation is shown below. Crow Company was incorporated 100 years ago. Only 100 years ago. It was funded by Joseph Crow, who established a small pottery making tableware such as dishes, plates, and cups. The products quickly grew popular, with one range of products becoming highly sought after when it was used at a royal wedding. The company's products have retained their popularity over the decades, and the Crow brand enjoys a strong identity and good market share. In how this group of companies established. So they started a business of pottery making 100 years ago with Crow Company. 10 years ago, Crow Company made its first acquisition by purchasing 100% of the share capital of the Starling Company. Both companies benefited from the newly formed CS Group. Crow, C, Starling, S, so they named it CS Group. As the Starling Company itself had a strong brand name in the pottery market, the CS Group has a history of steady profitability and stable management. So this is information about the company in how this group was formed, having no impact on our risk of material statement. This is just to waste your time while sitting in the exam center, so that when you will read the first line, oh, nothing like I understood, okay, read it again, read it again, read it again. So just ignore it. Just read once and move forward. So Crow Company and Starling Company have a financial year ending 31st July 2022, and your firm has audited both companies for several years. But now we are going to audit Canary Company. That is going to be added in consolidation. Exhibit 3, notes from meeting with Steve Eagle, Finance Director of CS Group, acquisition of Canary Company. The most significant event for the CS Group this year was the acquisition of Canary Company, which took place on 1st February 2022. Year end 31st July 2022. This means if Canary Company was acquired 1st February 2022, the results after 1st February should have been consolidated. Post-acqui only, pre-acqui results should not be consolidated. And the fair value of net assets acquired must be measured as per IFRS 3. If it is not measured as per IFRS 3 business combination, goodwill could be manipulated. We cannot say what's it, manipulated. Crow Company purchased all of Canary Company's equity shares for each consideration of $125 million. And further contingent consideration of $30 million will be paid on the 3rd anniversary of the acquisition. Who celebrate anniversary? Husband, wife. So subsidiary is like your wife. So they are acquiring Canary Company, paying 125 immediate cash, and 30 million will be paid after 3 years. If the group's revenue grow by at least 8% per annum, this contingent consideration for IFRS 3 should be incorporated into calculation of goodwill, but using discounted at present value method, not complete 30 million. You need to discount it using present value, then that amount you need to incorporate while calculating goodwill. Is that? See. Crow Company engaged an external provider to confirm due diligence on Canary Company. They engaged some consultants, due diligence that will measure fair value of net assets required, whose report indicated that the fair value of Canary Company net asset was estimated to be 110 million. Consideration paid minus fair value of net assets required is equal to what? Goodwill. At the rate of acquisition, goodwill arising on the acquisition have been calculated as follows. This is consideration cash they paid. This is contingent consideration, total 155 minus fair value of net assets required. They have calculated 45 goodwill. Is that amount correct? No. Because this contingent consideration should be incorporated using discounted at present value method rather than complete amount. But they haven't discounted at present value. This contingent consideration, they included the full 30 million.
Is
Yeah, we see that we need to consider. But that discount factor that we are using to discount that 30 million, that will be based on this probability automatically. That will be incorporating the chance. So we'll put a heading, what part B we are going to discuss. Risk of material misstatement. We'll put a heading goodwill first. And in requirement, it was stated you need to discuss matters that are not relevant for audit as well. So first we'll discuss materiality. How much is the value of goodwill? Is in the financial statements 45 million. Can we compare goodwill with any of the figures? Yes, the figures of our group are given here. Crow Company revenue profit given, Starling Company revenue profit given, Canary Company revenue profit given, and CS Group profit revenue given. But goodwill is a balance sheet item, not an income statement item. We cannot compare with the revenue or profit. Is there any total assets figure given? Yes, 550 million. So first we will discuss materiality of goodwill in 45 over 550 multiplied by 100 is a dash percent of total assets and hence material. And this is relevant. Material means relevant. Then we'll discuss if fair value of net assets required is not measured as per IFRS 3, goodwill could be manipulated. And per IFRS 3, contingent consideration involved in goodwill calculation should be incorporated using discounted at present value method. And incorporating complete 30 million without discounted at present value method, chances that goodwill could be manipulated. 2 points. Third, it is goodwill. There must be impairment review performed on goodwill per IAS 36. If there is no impairment review, chances that asset profit could be overstated and expenses understated. 1, 2, 3, 4 points we will discuss, and examiner will award us 4 good marks. Because these all points are relevant to this issue. These are involved in this issue. Is that? Okay, moving forward. To help finance acquisition, company need money to buy this. Crow Company issued a loan stock at par on 31st January 2022, raising cash of $100 million. The loan has a 5-year term and will be repaid at a premium of 20 million. 5% interest is payable annually in arrears. It is group accounting policies to recognize the financial liability as amortized cost. What is this? Loan stock. We'll put a heading loan stock. How much is the value? 100 million against total assets and hence material. Premium is how much? 20 million. That we will can compare with the profit of the company and hence material. Loan stock is what? Financial instrument. For IFRS 9. The premium on loan stock should be amortized over the loan period, that is 5 years. 5 years, yes. For IFRS 9, the loan stock should be initially measured at a fair value, and the premium at loan stock should be amortized over the length of the loan stock, i.e. 5-year period. If that premium is not amortized over 5 years, chances that financial statement could be manipulated. 1 point. And then there is a 5% interest on arrears. On arrears mean current will be paid in next, but should be recorded in current year as what accrued for. So 5% interest on loan stock should be accrued for in current year. Accrued for mean expense, debit, liability, credit. If it is not accrued for in current year, chances that expenses, liabilities could be understated and profit overstated. How many points? 1, 2, 3, 4. Is that? Or at least 3 marks are there. If combined materiality will be having 1 mark. Premium will be discussed separate. This will be discussed separate. There is 1 more point. Whenever we are discussing about financial instruments, we should always discuss about a disclosure of financial instruments for IFRS 7 as well. There must be a detailed disclosure in the financial statements for IFRS 7. In case of no disclosure, financial statement could be misstated. In case of no disclosure, financial statement could be misstated. Are you with me? Okay, moving forward. 2 issues we have discussed. Canary Company manufactures pottery, figurines, and ornaments. So Canary Company manufactures pottery, figurines, and ornaments. The company is considered a good strategic fit to the group, as its products are luxury items like those of Crow Company and Starling Company. And its acquisition will enable the group to diversify into a different market. Approximately 30% of its sales are made online. Who's Canary Company? And it is hoped that online sale can soon be introduced for rest of the group's products. Canary Company has only ever operated as a single company. So this is the first year that it is part of a group of companies. We'll put a heading Canary Company. This risk is relating to Canary Company. What's the issue? 30% of the sale of Canary Company is online. Let me find the figure for total sale of Canary Company. 16 million. Okay. See, we put a heading online sale. 16 million multiplied by 30% is equal to what? 5 point something?
4.8.
5 point?
4.8. 4.8.
No, 16 million multiplied by 30%.
Yeah. 16.
30% of 16 million. 4.8, okay. 4.8. This we will compare with consolidated revenue. What is consolidated revenue? 135. So divided by 135 multiplied by 100, and we will say this is that percent of total revenue and hence material. because it is above 1%, 4%, and hence material. In online sale, there is always issue of revenue recognition. Because while receiving order, company is recording revenue. But per IFRS 15, revenue must be recorded according to 5-step model or when performance obligation arises, i.e. delivery of goods to the customer. If company is recording revenue while receiving order, because company is taking payment while receiving order, so revenue could be overstated. We can discuss this one. Because this is advanced revenue, you cannot record it revenue until performance obligation arises. And especially at the year end, immediately before year end, if company have received order and company have recorded revenue rather than deferred revenue, then revenue could be overstated and liabilities understated. Because this deferred revenue, if you haven't recorded liabilities understated and revenue overstated. In online sale, we will always discuss this point. Revenue recognition. Second point, we'll discuss about e-commerce risk. E-commerce risk. If the controls over customer payment detail are not working effectively, and customer payments details could be hacked, misused, company need to pay damages of the customer. And those damages could create serious cash flow issue for the company, which may not be disclosed properly per IAS 1 in the financial statements. Not with me. We'll discuss about control over payment detail. If hacked, misused, company need to pay damages. And those damages could create serious cash flow for the company, which may not be disclosed properly per IAS 1. Risk we have discussed. How many points? 3 points we have discussed. One for materiality, one for revenue recognition, and one e-commerce is. Whenever there is online sale issue, we'll always discuss these two issues, revenue recognition and e-commerce risk. You're learning, adopting an approach, how to tackle different kind of issues in risk question. So how many issues? 3 issues we have discussed. Financial performance and position. Financial performance and position. The group has performed well this year. Okay. How they have performed well, sir? Okay, see. With the forecast consolidated revenue for the year to 31st July of 135 million, while previous year it was 125 million. As the revenue has increased by 10 million, so they are saying group has performed well. Okay. And profit before tax of 8.5 million, while previous year it was 8.4 million. As profit has increased, so group has performed well. They are saying. A breakdown of the group's forecast revenue and profit is shown below. Mean this 135 is calculated like this, and this 8.5 million is calculated like this. We compare this 135 with the previous year revenue, that was 125. They compare this 8.5 with the previous year 8.4 and increase. Is that comparing this 135 and 8.5 with the previous results like with like comparison? No. Canary was not there in last year. If you want to measure performance, you should exclude results of Canary from current year and then compare. And we exclude 16 million from this 135. That will be 119. And if we compare 119 with the previous 125, the revenue has decreased by this percentage, that is material. 5%, because 1% or more is material. And if we exclude 2 million of Canary company profit from current year profit of 8.5 million, that will be 6.5. And if we compare 6.5 with previous 8.4, profit has been reduced by this percentage. That is significant. Is that? And based on this real performance analysis, company is not performing well. This could create serious cash flow going concern issues for the company, which may not be disclosed properly in financial statements for IAS 1. In will link with cash flow issues. So we'll put the heading what? Financial performance. We'll say as per the results of Canary company inclusion, performance has improved because both revenue and profit has increased. But while deducting the results of Canary company, those were not there in previous year. Actually, the revenue has decreased by this percentage and profit has decreased by this percentage. And this could create serious cash flow going concern issues for the company, which may not be disclosed properly per IAS 1. Okay, let's move forward. Note, Canary company result have been included from 1st February. Okay, other matters. Starting company receive a grant of 35 million on 1st March 20x2. Government grant. Revenue nature should be treated as income. Capital nature must be deducted from asset cost, with the remaining amount asset should have been recorded. Okay, on 1st March, they have received government grant of 35 million in relation to redevelopment of the main manufacturing site. The government is providing grant to companies for capital expenditure on environmental friendly assets. This is capital nature. So for IAS 20, this capital nature government grant must be deducted from asset cost, and with the remaining amount asset should have been recorded. If it is not deducted, chances financial statement could be manipulated. This 35 million we can compare materiality with what? Total assets. Okay. Starting company has spent 25 million of the amount received on solar panel. Okay, that is environmental friendly. Which generate electricity, and intend to spend the remaining 10 million on upgrading its production and packaging line. If that 10 million is not spent on environmental friendly production or packaging line, this means they will not be meeting condition attached to the grant. If they are breaching condition attached to the grant, per IAS 37, there must be provision for full amount of the grant. And in case of no provision, due to non-compliance with the condition, chances that expenses liabilities could be. If there is no provision, chances that expenses liabilities could be understated and profit overstated. Is that? Let's put a heading what? Government grant. First, we will compare this 35 and hence material. We'll discuss per IAS 20, capital nature must be deducted from asset cost with the remaining, and then per IAS 37, in case of breach of condition, there must be provision. Is that? This 10 million, if it is not spent in current year, this should not be recorded as income. If you're gonna spend in future, these must be recorded as deferred income rather than income. And this 10 million is also material from profit point of view as well. So we can discuss this one as well. First, materiality, capital nature treatment, breach of condition, 10 million. If it is not spent in current year, they are intending to spend in future. This must be recorded as deferred income rather than income. In case of no deferred income, liabilities could be understated. Okay. During the year to 31st July 20x2, it was discovered that an error had been made by a member of a Kroc company finance department, which had resulted in the overstatement of deferred revenue by $10,000 in the prior period. Control issue. But there is error of $10,000. So we'll put a heading what? Accounting error. How much is the amount? 10,000. If we compare with 8.45 million company profit, this is what? Immaterial. So we'll say this is not relevant to audit planning as amount is immaterial. This is why they have a separate requirement. Identify any matter that is not relevant for audit planning in immaterial matters. If you have found, you need to discuss it separate. Are you with me? Okay. So this we have done. On 1st January 20X2, a new IT system was introduced to Crow Company and Starling Company. Newly installed IT system control issue, because due to early stage control weaknesses, misstatement may not be prevented detected by the system, or due to early stage control weaknesses, chances of error in financial statement. If we are discussing audit risk, under control risk, we will discuss due to early stage control weaknesses, misstatement may not be prevented, detected, corrected by the system. If we are discussing under risk committee misstatement, we will say due to early stage control weaknesses, chances of errors in financial statement. Okay, so they have introduced a new IT system during the year with the aim of improving financial reporting controls and to standardize the process across the two companies. Unfortunately, Starling Company finance director left the company last week. Firstly, it is newly installed IT system, always having early stage control weaknesses. And second, there is no finance director. In absence of finance director, even policies, our system will not be monitored properly. So we put a heading, what? IT system. So company have installed a new IT system due to early stage control weaknesses. And for early stage control weaknesses, there is one professional term that we can use that is called a teething problem. Teething problems. Teething problem is associated with the child at early stage of teething issues, he cry. And nobody can understand why he's crying. He is feeling some itching in his teeth at early stage, but nobody can understand why he is crying. It's the same issue with the new IT system, because there could be some bugs at early stage. Employees might not be aware how to use that system, and that system is creating problem for the organization, but nobody can understand why this system is creating problem. Our employee, if they are not willing to use that system, ultimately they are not using that system properly and then complaining about the system unnecessarily. And management cannot identify why there is a problem with the system, because we introduce the system to resolve the issues. Why there are some state there are problems. So due to early stage control weaknesses, i.e. teething problem. And if in the absence of finance director, controls are not monitored properly, chances of errors in financial statement. Because we are discussing the risk of material misstatement, this means we need to link every issue with chance of misstatement in the financial statement. Okay. What else? Share option. There was accounting standard on share option we have discussed. IS2, IFRS 2. What we discussed 2 points. The calculation should be based on fair value at grant date, and staff turnover must be incorporated into the calculation. Is that? Okay. So Crow Company granted 150 of its employees 600 share option each. 150 employees, they have issued 600 each option. On 1st August 20X1, Year end is 31st July. This means start of the year. Is that? The option vest on 31st July 20x3. How many years? 2 years. 2 years. This means the expense should be evenly distributed over the 2 years time period. Only those employees working for Crow company at the vesting date will actually vest. Means staff turnover should be incorporated. And the fair value of the option at various dates has been estimated as follows. On 1st August 20x1, the fair value of share is 6. On 31st July 20x2, the fair value is 8. And 31st July 20x3, the fair value is 9. At what price calculation should be made? 6, 8 or 9? 6, because this is fair value share at grant date. Is that not vesting date? That is 9. During 20x2, 5 employees left the company. My God. And Crow company anticipate that a total of 10% of the current employees will leave in the course of vesting period. This is what normal staff turnover. That must be incorporated into the calculation. Is that? And Crow company has recognized 720,000 as an expense as a non-current liability of the same amount. And how they calculated the 720,000? 150,000 employees, 600 option each employee multiplied by share value of 8. First, the value of share must be used 6 rather than 8 at grant date. And second, they haven't incorporated what? Staff turnover. Is that? This means 150 multiplied by 600 multiplied by 90%, because 90% option will vest rather than complete 100%. Is that? Then this must be multiplied by with $6. Is that? What amount you can calculate? Whether complete will be charged in current year? No, should be distributed evenly over the 2 years time period. Then all this must be multiplied by 1/2. Then you calculate the amount from 243,000. They have recorded how much? 730,000. Is that? By how much it is overstated? 400 and
477.
this means share option expense and liability has been overstated by 477,000. So we'll compare this 477,000 materiality with profit with total assets and hence material. So we'll put the heading what? Share option. So 477, this is material. For IFRS 2, the calculation of share-based payment must be based on fair value at grant date, i.e. 6 in this question, in this scenario. And the staff turnover must be incorporated into the calculation, i.e. 10% in the scenario. Is that? If company is not calculating based on this criteria, financial statement could be manipulated. Is that? And this we can show how we calculate this 477. We can show the calculation 150 multiplied by 600 multiplied by 90% multiplied by 6 multiplied by 1/2 is equal to this minus 720. So 477 overstatement is that percent of total assets and profit and hence material. In this calculation, you need to show how you calculated this 243. And while comparing 243 with 720, by how much it is overstated? Liability and expense should have been recorded with 243 in current year. Same will be recognized in next year. What they have done, they have recorded all in current Even the calculation is wrong with these two figures. They haven't incorporated staff turnover and they used different value of shares rather than value of shares at grant date. Mean for the current year, the expense and liability should be 243. Same will be in next year. But instead, they have recorded complete in current year with the wrong amount. Is that by how much it is overstated? That figure we need to calculate to check materiality. Okay, Crow company has recognized, okay, finish. How many risks we have identified? Let's see, for 22 marks. If we look at goodwill, 1, 2, 3, 4. Loan stock, 1, 2, 3, 4, 5. Okay, consider it 4, 8 marks. Online sale, 1, 2, 3, 11. And this financial performance, both revenue, profit, 2 points, and then linking with IAS 1, 3. Government grant, 1, 2, 3, 4. Accounting error, 1. IT issue, 1. And this share option will be having 4 to 5 marks because calculation is also involved there. So for 22 marks, we can discuss risk. Okay, let's move forward towards requirement C. Before moving towards requirement C, let's discuss how to verify goodwill. What is goodwill? Difference between consideration paid and fair value of net assets acquired. Difference between consideration paid and fair value of net assets acquired. How we can verify goodwill? We need to verify consideration paid. And we need to verify fair value of net assets acquired. We can verify goodwill. Is that how to verify consideration paid? How we can verify the amount of consideration paid? Inspection of purchase contract, from where we'll be able to verify the amount, whether complete, fully paid, or whether there is any contingent consideration, how much is the amount they agree, and cash book bank statement from where we can see they have paid that amount. If haven't paid amount complete, this means there is contingent consideration involved as well. Is that how we can verify fair value of net assets required? To verify fair value net assets required, we need to perform some procedures as per ISA 540. ISA 540 is what? Auditing accounting estimates and fair value. If we need to verify accounting estimate, we'll perform these procedures. If we need to verify fair value measurement, we'll perform the similar procedures. What are those procedures? Let's learn. First, we should inspection of management calculation. Inspection of management calculation for accuracy. Second, ensure consistency of accounting policies applied. The management have applied same accounting policies in measurement of fair value that they applied normally. How we can check what are the normal accounting policies? By comparing with the past records. From past records, we'll be able to identify what were the accounting policies they normally use, and then we will see same depreciation rate method they have used while calculating fair value of assets. Assess reasonableness. What? Assess reasonableness of accounting estimate. Reasonableness of accounting estimate and a judgment made. If management used any estimate judgment while calculating value of any assets, so we need to assess whether those accounting estimate and judgment are reasonable. How? By discussion with management. They are depreciating asset on 10 years. We'll ask them how you can use this asset for 10 years. For 20 years, how you can use this asset for 20 years. To see whether the things they are explaining are reasonable or not. They are depreciating motor vehicles on 10 years. How you can use this motor vehicle for 10 years, because normally motor vehicles become scrap after 3 to 5 years. How you can use for 10 years? Might be they will explain, oh sir, we wash motor vehicle every day. Either we wash our mouth or not, that is different, but we wash the vehicle every day. We kept a secure motor vehicle under shaded area, something like that. I mean, we care too much about motor vehicle. That's why we can run for 10 years. Okay. What else we need to do? Recalculate. Calculate on fair value. Being auditor, we will calculate on fair value as well, using the data. And compare. Compare with management calculation. Management calculation or any expert calculation that was due diligence report by expert relating to that subsidiary canary. And with management calculation, to see if same. If not, obviously we will investigate the differences. And in recalculation of on fair value, if we need to use any of the expert, we will consult independent expert as well. So engage independent expert in fair value calculation if required. And that we will charge to home client, because there could be some assets whose value we cannot measure ourselves. We are going to conduct audit of any of the company who is doing oil operations. They are selling petroleum and gases. And they have stated huge amount of inventory of petroleum and gases in their financial statement. We asked them, where is that petrol? They said, under the earth. Can we measure how much petrol they are having? No, we need to engage some of the expert. They will measure and will tell us the quantity of the gas, quantity of the petroleum. Is that? We are going to conduct audit of any of the company whose inventory is showing a huge amount of gold, diamond, jewelry. We asked the management, where is that? They said, see, it is there. And we verify it's original gold, it's original diamond having that much value. No, we need to consult some of the jeweler, some of the expert. Is that? So first we need to inspect management calculation for accuracy. We need to ensure consistency of accounting policies applied while comparing with past records. We need to assess the reasonableness of the accounting estimate judgment made by management by discussion with them. We need to recalculate on fair value and compare with management calculation to identify any differences. And in measuring on fair value, if there is a need for engaging any expert, we will engage them. And one more, the assets that has been written in fair value, if that asset is going to be sell after year end, we need to see at what value it's going to be sell. Whether the value is similar to the fair value recorded in fair value measurement or the different. If the value at which asset is going to be sell is too much different, this means that fair value was overstated. So what we need to do, inspection of post year end disposal receipt to ensure sale is made on fair value. Because if it's the sale is made on the amount that is too much different than fair value, this means that fair value was over or understated. So these procedures we should memorize. Now we can verify goodwill. One for verifying cash consideration and 1, 2, 3, 4, 5, 6 for verifying fair value of net assets required. If we move towards the question, requirement C of the question. Design the principal audit procedures to be performed in respect of goodwill initially recognized on the acquisition of Canary Company. We need to write down the procedures to verify goodwill. Straightforward, we can move on, or we can link a little bit with that contingent consideration. So ensure whether contingent consideration has been incorporated using discounted at present value method or not. Regarding impairment, we can write down one procedures. Review whether impairment required for the goodwill or not. And question is not finished yet. There is another requirement for 6 marks. Evaluate the ethical implication of these 3 requests. There are 3 requests. You need to discuss ethical implication mean ethical issues mean threats. So during the discussion, Steve Eagle, finance director of the company, said that he would like me, who is saying this? Engagement partner. So during the discussion, Steve Eagle said that he would like me to attend the CS Group board meetings on a monthly basis so that our firm can be made aware of any issues relating to the audit as soon as possible. The first issue is what? Attending a client board meeting. Attending board meeting. What's the issue? If we are attending board meeting where client are discussing about their business, they are making some decision about their business, this means we are performing manual level function. And if we are performing manual level function being auditor, it could create advocacy threat affecting auditor independence and objectivity. What should be the guideline? Attending client board meeting is not prohibited. Auditor can attend, like for obtaining information about their business, about their policies, about their decisions, but should not be involved in a final decision making, because decision making is of company manual level function. So we can attend, but we should not be involved in decision making. One issue. Also, Steve asked if one of our audit manager could be seconded to starting company in temporary replacement of his finance director who recently left. Secondment of staff. Create what? Self-review threat. Because finance department people are involved in preparation of financial statements and will be auditing our own perform audit work. So if we are having separate staff, we can perform these kind of services through Chinese walls. And who recently left and asked for our help in recruitment of a permanent replacement. Client staff recruitment. If we are involved in staff recruitment, again advocacy threat. So it's not prohibited. Auditor could be involved in staff recruitment, but up till the extent of analyzing the application as well as conducting interviews should not be involved in final selection of the candidate, because final selection is a responsibility of company management, not the auditor. Can we discuss these three issues for 6 marks, 2 marks each? Let's take a break. After break, we'll cover one more good question on group audit. Then we'll be able to wind up group audit as well as risk scaling. So that from next class, we'll be moving towards the last area of our syllabus. Stay with me, student.
I'm a break by girl. Hai जना मलाई मान्छे किन चाहिएको खाएर त्यस्तो मान्छे त्यस्तो त्यस्तो त्यो सुकेको गोलोसँग कहाँ हुन्छ होइन साथी म्यानेजमेन्ट नपले के भयो भन न हल्का फुल्का आज जित्यो कि हार्यो त्यति भन्नु न
Okay. ECC Advanced Audit and Standards. So we are discussing about risk area. Risk relating to group audit. So let's discuss one more good question. Stop. We look at the question, the requirements are inside the question. So let's start reading. So you are an audit manager in Compton and Company, responsible for the audit of the Stowe Group, the group. And you are planning the audit of the group financial statements for the year ending 31st December 2023. The group's projected profit before tax for the year end is $200 million. And projected total assets at 31st December are $2,500 million. So profit for the group and total assets for the groups are given. The group is a car manufacturer. Its operations are divided between a number of subsidiaries, some of which focus on manufacturing and distributing the cars, while others deal mainly with the marketing and retail. All components of the group have the same year end. The group audit engagement partner, Chad Woodstock, has just sent you the following email. See you, manager from partner regarding Stowe Group audit planning. Hello. We need to start planning the audit of the Stowe Group. Yesterday, I met with the group finance director, Marta Bitford, and we discussed some restructuring of the group, which has taken place this year. A new wholly owned subsidiary has been acquired, Zanner Company, which is located overseas in Farnet, foreign subsidiary acquisition during the year. Another subsidiary, Broadway Company, was disposed of. There is disposal of subsidiary during the year as well. I have provided you with a summary of issues I discussed with Marta. And using this information, I would like you to prepare briefing notes for my use, in which you, party for 12 marks, explain the risk of material misstatement. Explain the risk of material misstatement to be considered in planning the group audit, commenting on the materiality to the group of financial statements. So you need to discuss materiality of each issue as well. From now onward, in every risk question, either examiner asks for materiality calculation or do not. If we can calculate materiality, we need to discuss it. If there is amount given for any issue and we can calculate a materiality, we should always discuss. So risk of material misstatement, materiality we need to discuss. And part A2 for 4 marks, identify any further information that may be needed. What does that mean? Further information, additional information. Further information or additional information, name of documents relating to that matter that we can see at the planning stage. Name of document that we can see at the planning stage that we need to discuss as well. Mean along with each issue, we need to discuss additional information, and there are 4 separate marks given for additional information. This means at least 8 additional information relating to all the matters we need to discuss. And part B, we don't know. So risk of TM statement we need to identify, and we need to discuss name of document relating to that issue. There is part C as well, we don't know. Acquisition of Zanner Company. In order to expand overseas, The group acquired 100% of the share capital of Zenner company on 1st February 2023. What was the year end? Was the year end 31st December 2023. So on 1st February 2023, during the year, they acquired Zenner company. Zenner company is located in Farland. This is foreign subsidiary as well, where it owns a chain of car dealerships. Zenner company's financial statements are prepared using international financial reporting standards and are measured and presented using the local currency of Farland, the Dingo. At present time, the exchange rate is 4 Dingo to $1. Zenner company has the same year end as the group, and its projected profit for the year ending 31st December 2023 is 90 million Dingo, and projected assets at the same date 800 million Dingo. So first we will put the heading Zenner company. Part A. 1. Risk of material misstatement, and we put the heading Zenner company, and its profit and total assets are given. The rate is 1. 4 Dingo is equal to $1. So profit is 90 million Dingo. So 90 divided by 4, $22.5 million. And its total assets, 800 divided by 4 is equal to $200 million. And if we compare with the consolidated profit and total assets, profit consolidated is what? Consolidated profit is what? 200 and 2500. 200. So divided by 200 and hence material, this percentage, and divided by 2500 is equal to this percentage and hence material. Because he has asked, you need to calculate materiality as well. Now there is issue of a foreign subsidiary. So put a heading foreign subsidiary. For IAS 21, income statement item should be translated using average rate. Balance sheet item should be translated using closing rate. Foreign exchange gain loss should be charged to P&L. Foreign exchange gain loss relating to retranslation of subsidiary assets should be charged to OCI. And if company is not accounting as per above criteria, financial statement could be manipulated. Is that? What is the requirement A2? Additional information. What could be additional information relating to this issue of foreign exchange? Documents relating to result conversion. Calculation of result conversion are documents relating to result conversion. So calculation of result conversion. Is that? Okay. Next, moving forward. Zenner company is supplied. Okay. Now there was another issue. This is the subsidiary acquired during the year. So put a heading what? Acquisition during the year. If acquisition during the year, for IFRS 10, only post-acqui result must be consolidated rather than pre-acqui. And if due to inappropriate apportionment of post pre-acqui results, financial statement could be manipulated. So apportionment of result we can discuss for IFRS 10. Okay. Then if there is acquisition during the year, fair value of net assets acquired must be measured properly for IFRS 3. If it is not measured properly, goodwill could be manipulated. Is that? Can we discuss contingent consideration? No, there is no information about it. Do we need to discuss about impairment of goodwill? So there is no information about goodwill. Or if you want, you can discuss. For IAS 36 impairment. The documents for these issues relating to apportionment, working document of result apportionment. So working document of results apportionment. And a fair value, due diligence report. Due diligence report through which we will be able to identify fair value of assets acquired. Regarding impairment, impairment review copy. That is performed by company management impairment review copy. Is that? So we have stated 4 additional information. Let's move forward. Zener company is supplied with cars from group's manufacturing plant. Intergroup transaction. The cars are sent on cargo ships and take approximately 6 weeks to reach the main port in Farland, where they are stored until delivered to the dealerships. At today's date, there are cars in transit to Zener company with a selling price of $58 million. First, put a heading, what intergroup transaction? The value is what? 58 million. So 58 million is inventory against 2,500 total assets and this percentage enhanced material. Is that? For IFRS 10, unrealized profit part relating to unsold inventory involved in intergroup transaction at year end must be eliminated at consolidation. If unrealized profit part is not eliminated, chances that inventory and profit could be overstated. Unrealized profit part relating to unsold inventory at year end of intergroup transaction must be eliminated at year end. Must be eliminated at consolidation. Is that? Okay. Now there is some further issues. They are saying the cars are in transit for 6 weeks. So there could be cut-off issues. If suppose before year end, one company have sold, transfer good to others and they have recorded sale and other haven't recorded purchase because they haven't received the inventory yet. If they haven't recorded the purchases, they have excluded the inventory. And due to that, inventory could be understated. Is that one issue? Second issue, they transfer the goods and they haven't recorded the sale. Because we'll record sale when goods will deliver over there. And the other company have recorded purchase. So due to this, inventory could be overstated. If one have recorded sale, other haven't recorded purchases because there are 6 weeks in transit. Or one haven't recorded sale, other have recorded purchases because goods have started moving towards our business. So due to that, inventory, not only inventory, even receivables, payables could also be under overstated because they will record sale purchase on what? Credit basis. They have recorded sale. Receivable, debit, sales, credit, they haven't recorded purchases. This means receivable, overstated, inventory, understated. They haven't recorded sales, they have recorded purchase. Purchases, debit, payable, credit. So inventory and payable could be overstated. Is that? So this is what another is cut off. Now what could be the document relating to this? GDN's GRN's copy. GDN's / GRN's copy of intergroup transaction. which will be able to identify where sale and purchase should be recorded, what is the profit part included in that. Okay, moving forward. A local firm of auditors was engaged by the group to perform a due diligence review of Zanner company prior to its acquisition. We've already discussed due diligence report. The group statement of financial position recognized goodwill at acquisition 60 million. Oh, they have recorded goodwill relating to Zanner company. So this acquisition will put a materiality of goodwill as well. How much? 50 million divided by 2,500 total asset and hence material. The remaining point we have already discussed. Is that? So instead of due diligence report, we can put one more document, purchase contract copy, which will be able to identify what is the amount of investment mean consideration paid. Is that? Compton and Company was appointed as auditor of Zanner Company on 1st March 2023. At that time, now before that, they have acquired that. That's why relating to result apportionment we need to see. Disposal of Broadway Company. On 1st September 2023, the group disposed of its wholly owned subsidiary, Broadway Company, for proceed of $180 million. Broadway Company operate a distribution center in its country. The group's statement of profit or loss include a profit of 25 million in respect of the disposal. So sale is made on 180 million and the profit they have recorded 25 million. So we'll put a heading what Broadway Company, because this risk is relating to Broadway Company, and we will say disposal during year. This is the issue. 180 million disposal. We can compare with what revenue is not given, so we can compare with the total assets and hence material, and 25 million we can compare with 200 profit and hence material. Is that? Now relating to disposal, what are the risks? For IFRS 10, pre-disposal result must be consolidated rather than post-disposal, and due to inappropriate apportionment of pre-post disposal results, financial statement could be manipulated. In only pre-disposal results should be consolidated rather than post-disposal. Is that before disposal? And then for IFRS 10, assets relating to disposal group should be eliminated from asset register. If assets not eliminated, asset could be overstated. And then for IFRS 3, goodwill relating to disposal group should be eliminated from goodwill account. And if it is not eliminated properly, goodwill asset could be overstated. Is that? Then for IFRS 5, detailed disclosure of a significant discontinued operation must be provided in financial statements. In case of no disclosure, financial statement could be misstated. And this 25 million profit is significant. There is accounting standard IAS 8, accounting policy change, estimate change, that is requiring disclosure about a policy change, estimate change. IAS 8 also require if company is making any significant gain or loss through non-routine transaction. What are routine transaction? Purchase, sale of inventory. Purchase, sale of asset is what? Non-routine transaction. If company incur any significant mean 10% or more of total profit, total assets, total revenue. That gain loss, company need to provide a separate disclosure in the financial statements. And in case of no disclosure, financial statement could be misstated. 1, 2, 3, 4. Risk and 1 materiality we have discussed. What are the documents relating to this? Now we can verify sale is made on 180. Sale contract, sale agreement of Broadway. How we can verify profit of 25? Fair value of Broadway, copy of fair value of assets of Broadway. Broadway, fair value of assets, copy. What else? Asset register, copy to verify elimination of assets. Is that extract but other things will be able to find during audit at planning stage what documents we can see. Asset register we can see at planning stage.
Yeah.
If this sale has been made before our appointment at the planning stage. Okay. Broadway company was acquired by a retail organization, the Cornwall Group, which wished to bring its distribution operation in-house in order to save cost. Compton and Company resigned as auditor to Broadway Company on 15 September 2023 to be replaced by the group's audit on the Cornwall Group. That's why we need to verify post-submit of results. So for 12 marks, we need to discuss risk of material statement, and for 4 marks, we need to provide additional information. So I think we have done justice with part A of the question. Is that? Zanner Company, foreign subsidiary, goodwill, intergroup transaction, and then disposal. And regarding disposal, we have discussed about 5 points separate. Not evidence. Documents relating to that matter that you can see at planning stage from client record. Evidence are what? Outcome of your procedure. Evidence, outcome of your procedure. Written presentation is evidence, not additional information. Written presentation is evidence, not additional information. Source of discussion with management is evidence rather than additional information. Additional information means at planning stage, before starting the audit work, what document you can see relating to that matter. Ultimately, that will also be evidence. But this is additional information at planning stage. This is document that we can see at planning stage. We don't need to name the document that we obtained during audit. Okay, there is further information. Zanner Company internal audit team. The internal audit team was established several years ago and is headed up by a qualified accountant, Joe Evesham, who has a lot of experience in designing system and controls. Joe and her team monitor the effectiveness of operating and financial reporting controls and report to the board of directors. If internal auditor reporting to board of directors, he will not be working independently. To whom he should report? To audit committee to maintain his independence. This means audit team, internal audit is not independent. He's working under directors, mean management influence. Zanner Company does not have an audit committee as corporate governance rules in Farland do not require an internal audit function or an audit committee to be established. It is not required. This means it would not be effective even. During the year, the internal audit team performed several value for money exercises, such as reviewing the terms negotiated with the suppliers. During audit, being an external auditor, sometimes we rely on the work of internal auditor. What internal auditor does, he review internal control system and highlight weaknesses for company management. How he review internal control system? By performing test of control and substantive procedure. And if we use the working paper of internal audit, test of control substantive procedure, this can reduce our audit work. But only audit work, not the responsibility. Tomorrow will not say these procedures were performed by internal auditor, so we are not liable for that. No, we will be liable. That's why before relying on the work of internal auditor, we need to assess his qualification, experience, reputation, application of standard in his work, his independence. His independence, that is very important. Because if he's not independent, he will say everything that company management wish. Is that? So if he is performing value for money review, that is not relating to review of internal control system. Value for money review means he is assessing 3 E's, whether business is achieving economy, efficiency, and effectiveness or not. If he is performing a review of internal control system, then we should rely on his work, because that work is relating to our work. So value for money review is not relating to our work, and he is not independent because there is no audit committee. Even he is not compulsory for the organization. Might be he is not effective. Might be he doesn't have qualified staff as well. Okay. Before part C, there is one paragraph. Part B still left. We're gonna deal later on. Part B left. Mata has told me. Mata, who's Mata? Finance director of the company. Who is saying engagement partner who has written an email for you, audit manager. So Mata, finance director, has told me that Zenner company has a well-established internal audit team. And we have seen how much well-established they are. She has suggested that we use the internal audit team as much as possible when performing audit of Zenner company, as this will reduce the audit fee. Whether we should rely on the work of internal auditor work or not, this is the decision of external auditor, not the company management. They cannot influence us. They cannot pressurize us. Okay, by relying on the work of internal auditor, we can reduce our work, our audit cost, as well as we can charge lower fee to the audit client, but this should not be pressurized by the client management. If they are pressurizing, you should rely on his work and charge lower fee. This kind of pressure affect auditor independence, objectivity, creating intimidation threat. We should discuss this kind of pressure with the audit committee or those charged with the governance. If still unresolved, we should resign from the engagement. The group audit committee appreciate that with the audit of the new subsidiary, there will be some increase in our cost, but has requested that the audit fee for the group as a whole is not increased from the last year fee. No, if our work is going to increase, ultimately cost is going to increase, we need to charge more fee. If we pressurize not to charge more fee, due to cost pressure, our work could be compromised, creating intimidation threat. So we need to discuss with management to resolve this issue. If still unresolved, we should consider withdraw from the engagement. I have provided you with some information about the internal audit team, and in your briefing notes, I would like you to discuss how Mata suggests the impact on planning of the audit. We need to discuss, okay, our work could be reduced by relying on the work of internal audit team, but not the responsibility. That's why whether to rely on his work or not, who should decide? Auditor, while assessing his qualification, competence, experience, reputation. Is that independence as well? And of the group's financial statement and comment on any ethical issues. These two ethical issues we have discussed. Intimidation threat. And we will discuss one paragraph whether we should rely or not, who should decide, and his independence as well. How many marks? 7 good marks. Are you with me? Now moving towards the most important part of this question. From where your pass or failure will be decided. Part B, for 8 very good marks, Discuss the principal audit procedures to be performed in respect of the disposal of Broadway Company. They disposed of one Broadway company with 180 million, generating 25 million profit. You need to write down procedures to verify disposal of Broadway company. How many procedures? Only 8. Can you try by yourself to assess how many you are able to write down at the moment? Please try to write down procedures to verify disposal of Broadway. See what document you can inspect. And the risk we have discussed, move to those risks and see what document you can inspect relating to these issues. Whether board minutes you need to review or not, this is management level function. Obviously, board minutes we need to review to see how management considering the disposal and accounting for it. Try how many you can write.
I wrote 6. First one is inspect the
To
sales.
pass, you need at least 4.
Yeah, I made it wrong as well.
Let's discuss. So first we can inspect
That's
sales contract to verify amount of sale of 180. Is that? Okay, from where we can verify the fair value of assets disposed. Inspection of asset register. Verify the value of asset disposed. Recalculation of a profit of 25 million compared with manual calculation for accuracy. Review board minutes to verify authorization for sale. Verify authorization for sale. What else? Inspect goodwill account to verify elimination of goodwill relating to disposal group. Review financial statements to verify completeness of disclosures of a discontinued operation as per IFRS 5. What else? Inspect asset register to verify what elimination of asset relating to disposal group, and then result apportionment pre-post disposal. So what you will do, inspect of inspect the working of a result apportionment to verify only pre-disposal results have been consolidated. What else? Cash you have received. So inspection of cash book bank statement to verify receipt of disposal. At least 8 we must be able to write down. And if we are having practice, we'll be able to write down 5 to 6 at least. Without practice, after 2 to 3, everything will be blank. We'll be looking at others, what they are doing, why I'm not able to write down 8 procedures. And this is the part that will decide pass or failure of your paper. It will be 20 to 25 marks. Not in one question, in different parts of the question, even in audit report question, even in risk question, where examiner will ask to write down 5 procedures, 4 procedures, 6 procedures. Here, he has asked for 8 procedures. That is not justifiable. Because 4 or 5 students can write themselves, but for 8, it's very difficult. While sitting in exam center, where our senses do not work properly due to exam pressure. And this is a paper. If you are aware how to answer every part of each question, you will not be able to complete the paper within 3 hours. Maximum, a good student can attempt up to 90 marks. With enough practice. Without practice, even a good student will not be able to attempt above 70. Without practice, without knowledge, you can attempt only 50 to 60 marks. Entries are bad luck. We are not born in Gora's house, English people house. We are not having that much expert English that if we are answering for 50 marks, we can score 40 marks. No. Our English level is there. If we are writing down for 50 marks, we'll be able to get 25 marks. A maximum 30 marks, not more than this. It's not our natural language. Is that? We need to think how to prepare this sentence, how to write this. Okay, so moving towards group audit. Let's see, I think so. We have completed risk, we have completed group audit. Just we need to discuss 1-2 small topics so that we can wind up. Joint audit. What is joint audit? When two firms jointly conducting audit of any company financial statements, so that will be called joint audit. And normally it happens in group audit when you are having any of the subsidiary in foreign country, and that country law regulation could be different. That country accounting standard could be different. Auditing standard could be different, or corporate governance codes could be different. And due to lack of knowledge about local laws, law regulation, standards, sometimes you need to engage some of the local firm so that they should provide knowledge about the local laws, standards, and you will be having a knowledge about how to conduct the audit expertise. So that audit will be called joint audit. When two or more firms jointly auditing one client. Where it happens? Normally in foreign subsidiary. In group audit, where you are having foreign subsidiary. So there could be some advantages of joint audit. There could be some disadvantages. What could be the advantages? We can share expertise. We can perform audit quickly with having combined resources. But there could be some disadvantages. Disadvantages could be clashes between two firms, conflicts. Ultimately, it could affect audit quality. In case of a negligent report, both firms be blaming each other. Who is suffering? Client. There is another topic called a transnational audit. We have discussed this transnational audit in very first lecture, I think so. Not first lecture. Chapter 1. Transnational audit. Audit were performed beyond the jurisdiction of one country is called transnational audit. Audit were performed beyond jurisdiction of one country. We have learned laws, regulations, standard, everything relating to one country. We are performing in one country, but now suppose our client is having foreign subsidiary that we need to audit as well. And if we are moving towards that foreign country to conduct audit according to their law regulation, that is called transnational audit. Is that? What could be the issues in transnational audit? Financial reporting standard could be different. Auditing standard could be different. Regulations could be different. Corporate governance code could be different. And if we are facing any issue in transnational audit, we can get help how to resolve that issue from TAC. TAC stands for Transnational Audit Committee, working under IFAC, also called Forum of Firms. And in this Transnational Audit Committee, representative of the world top firms are sitting over there, and they are providing voluntarily help to the audit profession if they are facing any issue in transnational audit. This we have discussed already in chapter 1, I think so. Forum of Firms, transnational audit, IFAC, IASB, IAASB. We have discussed already this. And this chapter on group audit we have finished. So in next class, we will start our last area of the syllabus, that is non-audit engagement. So we are having class tomorrow. What time? Can we make it 5 to 8? 5 to 8. So tomorrow 5 to 8. 70% of your paper will be similar to the questions we are covering in the class. The same story, same requirement, even same issues. 30% of the paper, knowledge will be similar, but the asking a question requirement could be different. Issues relating to the company could be different, but the topics will be similar. The way of answering question will be similar. No current issue for this paper. First question mainly on risk. Could be group audit, could be single company audit. Could be like Parker analytical procedure and then identifying risk. Having some other parts as well, like some part of ethical, some part of reliance on the work of internal auditor, some part of writing down procedures or evidence. And from remaining two questions, one question mostly based on audit report with some other area, but mainly audit report. And one question mainly on ethics issue, or could be the topic that we're going to start from tomorrow, non-audit engagement. Corporate governance is not an area of this paper. Corporate governance is an area of AA as well as SVL. In AA, we are having one chapter on corporate governance. In SVL, we are having 6 chapters on corporate governance. It's not part of this paper. Corporate governance is not part of this paper. See you tomorrow. 5 to 8.